Going to go ahead and get started. I want to thank everybody for joining us for the December 2025 edition of the NDSU Extension Agricultural Market Situation Outlook webinar series. It's officially the last of the year, being December, and it's the actual end of our fall block of webinars. We are going to, I haven't asked everybody officially, but we are going to do this in 2026. I think that's just assumed. We'll have you re-sign up for the webinar, give you a link URL for the year to kind of clean up our books as things get going. So look forward to seeing that beginning in the next week. And if you sign up, you won't get reminders. If you wait to sign up, you'll keep getting them until the day of. But with that, want to go ahead and kick things off. As usual, a series of presentations. Brian, did you want to take questions after your talk? Yeah, Brian has to leave. He has another commitment shortly after, so he's going to give his talk first and then take questions if you have any. Then we'll continue on and through and keep the rest of the questions for you. And you can use either the Q&A tool or the chat tool, and we'll get to them. There's a lot of interesting things going on, and you're more than welcome to ask questions, kind of start a discussion with us as we have a lot of things going on in markets and policy and the like. But with that, I'll go ahead and turn it over to Brian.
Yeah, so I actually had a title for this. I forgot to title, but what I'm going to be talking about today is the interest rates, Federal Reserve stuff. They had a meeting yesterday, last meeting of the year. And so I'm going to kind of go over the results of that meeting, the policy direction going forward, and essentially what it means for the rest of us. So yesterday's meeting, again, the final one of 2025. At that meeting, they decided that they were going to go ahead and do a 25 basis point or a quarter of a percentage point cut to the federal funds rate. And one of the interesting facts about that was not a unanimous decision. In fact, 3 voting members, so there's more folks that go to these Federal Reserve Board meetings than just the 12 voting members. But in this vote, it was 9-3 in favor of cutting. So essentially 3 people at least wanted to hold the rates where they were, or maybe perhaps increase them. It didn't really say that, but 3 people, 3 of the voting members were not in favor of the rate cut, which dropped that federal funds rate down, with the target now being between 3.5% and 3.75%. And one of the reasons that they cited as being this rate cut being necessary was concern over the unemployment situation, or the employment situation, that hirings had slowed down to a degree. And you have to remember, when the Fed is setting its federal funds rate policies, or their interest rate policies, they're looking forward, not necessarily at today, because any policy change that they make today as far as the overall economy, it's not going to really, the full effect of any of those policy decisions are not going to be realized for many months into the future. So in their mind, while 4.4% is not high, and I put this slide up here to illustrate, that it's been relatively low really since 2017. In fact, the last time it was this high outside of the COVID period, I know you see that big peak in the center that was brought on by all the shutdowns, but really outside of that, this is the last time it's been around 4 to 4.5, really closer to 4.5% since 2017. So their concern is that there's some weakening in that, and they want to get out ahead of it. They don't want to wait till it gets to 5% or 6% to act, because then, like I said, it's still going to take months and months before the policy takes effect. So any action they take today is really for 2, 3, 4 quarters down the road. And if you're wondering what they think, the members who go to these meetings, where they think the long run federal funds rate should sit, this is 2025. This is what they believed at this most recent meeting, and you can see it's right there at that 3.5, between 3.5 and 3.75, where it currently sits. Now, if you're thinking, are there going to be rate cuts in the future? We'll talk about next year. Talk about that in a minute. But as you go down the line here, so The blue dots indicate the median projection. Really, they're pretty close to saying at this point that it's at the neutral rate, not neither hawkish nor dovish. In other words, not restrictive, but also not accommodative. That a lot of the folks that are voting on this are saying that the rate that we're at now, that 3.5 to 3.75, maybe it goes down to 3.25 to 3.5, but that based on current economic conditions, if things basically stay the way they are now, there probably won't be much need for a rate cut in the future. And here was the Fed Chairman Powell's most recent comments, is that considering the extent and timing of additional adjustments to target the federal funds rate, the committee is going to carefully assess incoming data, which basically, he says it right here, positioned in a wait and see how the economy evolves. Now, I know some of you are thinking that, his term's up in just a few months, but if I go back and show you where a lot of the voting members think rates should be, it's not off from what he's basically saying here. So it is a vote. The Fed chairman does not set the rate policy. It's done by a vote. So even if Powell is replaced by somebody else, it's going to depend on what the committee's overall vote and decision is, not just the Fed chairman. They don't make unilateral decisions. And I put this down here to show there are also 4 non-voting soft dissents and 7 individuals at the meeting basically saying they want no rate cuts at all next year. So right now, there's some friction between individuals thinking that rates have been cut enough. We need to adopt this wait and see, as well, and some individuals who are basically saying, well, we wanted to go ahead with that rate cut, but by and large, you won't see anybody looking at those dot plots who think that rates should be cut substantially in the near future. That's kind of where it's sitting. So, along with the federal funds rate, some decisions were announced regarding the Federal Reserve's balance sheets. And as I said at our ag lenders, but I want to bear it saying here because some of the folks who heard my talk at ag lenders, the people that are on here didn't hear it. And the importance of the Federal Reserve's balance sheet being long-term versus short-term. The federal funds rate impacts short-term interest rates more. The Federal Reserve's balance sheets has more of an impact on long-term rates as the Federal Reserve buys 10-year treasuries, mortgage-backed securities, things like that. If they're buying them off the market, that increases demand, right, which increases the price, which lowers the yields. So they all, or everything that I'm discussing here impacts interest rates, but they impact them differently. And so depending on long-term rates versus short-term rates, what the Fed's actually targeting, what they do matters more. Short-term on the federal funds rate, longer term on the balance sheets. And we look at what the Fed's policy has been for the last couple of years. They've been rolling off this balance sheet. And when they mean by rolling off, it's not like they go out and sell a bunch of treasuries and mortgage-backed securities. They just quit repurchasing. And at the height of their buying, they hit nearly $9 trillion. And as of recently, that had gone down to about $6.5 trillion or so as of the last month or two. And Reuters, I know this is a kind of a sparsely populated slide, but I just want to make sure I said it. The Fed's had the Fed's announcement clear. The Fed said on Wednesday it will immediately start buying short-dated government bonds for market liquidity purposes. Why I very specifically said short-dated. Short-dated is going to have probably a more weight on the shorter-term interest rates than the longer-term interest rates. Okay, and what it's basically telling you here is they're concerned about liquidity, short-term liquidity in the market, and not necessarily bringing down long-term rates. And the buying will be about $40 billion in treasuries per month. So what are they going to wind up buying? Basically, when they buy treasuries, T-bills, they're going to buy about 75% of them are going to be in the 1 to 4 month range and 25% in the 4 to 12 month range. So they're going to be buying a lot of these 1 month, 3 month, 4 month bills. And then when it comes to the longer term ones, they say it in their write-up that they're going to be treasuries that are 3 years or less, that maturity date is 3 years or less. The point being that what they're targeting here are these shorter term purchases to bring liquidity into the market for shorter term loan rates, which is going to have a more muted effect on longer term rates. And so how did interest rates react? Well, the Fed's decision was widely anticipated that it was going to be a 25 basis point cut, so it didn't react much, but you see where the reaction was. You had a larger basis point drop in short-term treasuries, 1 month. So I just show the 1 month here. It fell 5.5 basis points after the announcement. 2-year fell 5. Going to the longer term ones, the 30-year fell only 3 basis points. So it didn't move much, but because the market had already anticipated it, and if you've talked to or heard Frayne talk a lot of the times, many of these like reports from the USDA WASDs, you only see a massive market movement when industry misses the mark on what they expect to happen versus what actually happens. But until it's announced, there's still some uncertainty. But you can see that the bigger impact was on the shorter term bonds rather than the longer term, which again kind of reinforces what I was saying about the Fed's actions yesterday are going to have probably a bigger impact on short-term rates versus like 30-year mortgages and 15-year mortgages. And so just talking about interest rates and what we have seen with it, really the 30-year mortgage is down about 0.5% since last year, or 50 basis points, coming down from 6.7% down to 6.2, and then the 15-year down is roughly down about the same, from 5.9% down to 5.4 to close out 2025. And then looking at ag loans, this is the most recent data that we have. This is from the third quarter of this year from our Minneapolis Fed. Operating notes down from 2 years ago, down by almost a percentage point. Same thing with machinery loans, down a little bit less than a full percentage point, but down 7 or so. And then the real estate loans we're down about 8% heading into third quarter. My expectation is that we'll probably see a little bit of a reduction in all these based on what the Fed's done recently, but I don't think it's going to be dramatic. And it may be 0.25%, but probably not that much, probably a little bit less. So, and looking forward, like I said, you look at those Federal Reserve comments from Jerome Powell. I know he's the one who's given the comments, but he doesn't unilaterally speak for it. He takes everybody's inputs and what they're going to do. I think 2026 for at least the next few quarters is going to be a wait and see. If some unanticipated change happens, massive layoffs for whatever reason, who knows, then they could probably change course. But if it's kind of business as usual as it's been for the last 6 months at the macroeconomic level, I don't anticipate seeing any kind of appetite among the Federal Reserve voting members for another rate cut. So it's kind of what we're looking at. I wanted to summarize that meeting because I know it does have an impact on rates as we're talking about renewing operating notes and things like that heading into next year. I don't expect to see a big rate drop anytime soon. I think kind of where we are today is we're going to be where we are heading into next year. So definitely,
Brian, I have a question or something. If you could
Yep.
touch on a little bit, I heard something in the news, which I think was I shouldn't say that. It was on YouTube, which I think was a bad take, bad understanding of financial markets. But understanding. Can you explain a little bit about the interest rate that the Fed is changing and its relationship to various loans or financial products, a 30-year mortgage, an operating loan, and the like, because there's not perfect correlation. Could you explain that a little bit?
Yes. All right. So the federal funds rate is a very short-term discount window rate that the Fed, who is considered the lender of last resort, charges to meet the required reserve ratio overnight. And so the lower that you make that federal funds rate, basically, the more likely a bank is to lend out beyond that federal the required reserve ratio, and it basically makes money cheaper. And so then what that also does is, if I'm borrowing from either other banks or the Fed, I can't loan you money at a rate that's lower than what I got to borrow it for. Okay, I gotta charge you plus a risk premium and everything else, and some time value stuff. I got to charge that. So as the Fed lowers the federal funds rate, it lowers that cost of that overnight lending for short-term, for short-term or intermediate-term loans, or the cost of not meeting the required reserve ratio based on deposits. And so that's an indirect impact on your mortgage rate, because here's the other. So that's on the short-term side. So on the longer-term side, mortgage rates, things like that are 30 years, uh, I have to basically that's more applicable to the 10-year treasury, okay, or the 30-year. Because when a bank loans out for a, let's say, mortgage, okay, a lot of times they don't hold on to it. Most of the time they don't hold on to it. They package that mortgage and they sell it on the open market to investors. Well, if you are looking to invest, if you're an investor and you're investing in either a mortgage or a 10-year treasury, you're going to have to get a better rate from that mortgage-backed security, because that's higher risk in theory than a treasury is. The treasury, you're going to get your money back. So how much more do I need to get to convince me to buy a mortgage-backed security versus buying a treasury? I'm going to have to get something more than the treasury. And because of risk and everything else, I'm going to have to get considerably more than the treasury. So that's how they repackage it and sell it. And then the flip side is, as the federal government, or another aspect of it is, as the federal government's issuing debt, okay, the more debt they issue, the more of those treasuries have to be bought up. Okay, so the more and more of that's on the market that has to be bought up. Now, what if you in your portfolio have all the debt that you would possibly want, all the treasuries that you want? How would the government get you to buy more than you really want? They have to offer you a higher yield. If the government offers you a higher yield to buy theirs, guess what mortgages have to do? They have to go up even more, because they got to be higher than what treasuries are being offered for. Okay, so the Fed coming in and buying a ton of, but so then the Fed can control that on the flip side by buying mortgage-backed securities, which then increases demand and gets those bought up. So there's a lot of balls in the air, is why when somebody says, "Oh, well, the Fed dropped the federal funds rate 50 basis points or 0.5%," why didn't I see mortgage rates go down? I know they have to be higher, but why didn't they go down 50%? Well, there's several moving parts, and I didn't even hit them all, but several moving parts that determine this rate. And if you adjust any one of them, and basically what the Fed's doing here is saying, yeah, we're going to keep buying, or we're going to go back into a buying mode and increase our balance sheet, but we're only increasing it on the short end. So the longer terms are not going to be as impacted as the shorter ones. Now, they do have spillover, though, because somebody interested in 2-year might be convinced to, 30-year. It's kind of like as cropland prices go up, so do pasture land, because in theory, you could always till up pasture and raise crops on it. And maybe that's not that practical, but, the substitution effect kind of deal there. Same kind of thing going here. I know that was long-winded and a lot in it, but that's really the problem. I wanted to really try to illustrate how many balls are in the air being juggled, and why it's not just this direct, we cut the federal funds rate, interest rates should come down, or we roll off our balance sheet, interest rates should come down, or increase our balance sheet, interest rates should come down, I should say. That's really why, is because and then lastly, you have people's expectations, the consumer expectation. If you think that rates are going to go up in the future on bonds, what do? Like, yields are going to go up. You wait, right? You wait to buy it. And if everybody's waiting to buy bonds, so I got to increase the yield to get these bonds sold, guess what happens? Yields go up. Crazy how that works, right? Or if you think that rates are going to go down and you want to lock in a nice high yield, guess what we do? We wait. Or we hurry up. I'm sorry, we get this flip side. We hurry up and buy, right? We hurry up and buy. Or if I'm holding on to bonds with a yield that I like, you're really going to have to convince me to sell. And guess what happens when prices go up? Yields go down on bonds. They work opposite. Mm-hmm. So this is kind of a confusing topic, I know, to cover on a webinar, but that's hopefully that kind of cleared some of that up. And then I see a question: are long-term rates ever going to start coming down, or just short-term? Yes and yes. They have been coming down a bit. Like I said, I showed in the that chart that the 30 years basically down 0.5% in the last year. Uh, but it looks like, based on the actions that the Fed is taking, that they're targeting those short-term rates. So that's naturally going to pull longer-term rates down with it some. But I think what you're going to see is a bit of a steepening of the yield curve. You're going to see 10-year come down a little, like the 10-year Treasury, 2-year come down even more, the 1 months and the 3 month ones even more, which you basically saw, although a little bit muted. And so that yield curve is going to steepen. You guys have all heard about the inverted yield curve. That's when the 2-year yield is higher than the 10-year. That's generally happens when people are afraid of a recession, so they run to the 10-year bonds and flee equities and try to basically hold their wealth and ride it out. Now it's steepening, not because necessarily people are fleeing the 10-year, but the adjustment in the 2-year prices is basically what's going on there. So they will both come down, but I think the 2-year and the shorter term ones will come down even more as a percentage. Hopefully that answered your question. I appreciate you guys being with us all year. Those of you who read Ag by the Numbers, we certainly appreciate everyone who does that. I'm grateful that you're all taking the time to be with us, and hope everyone has a great rest of the year. Thanks.
Good afternoon, everybody. Excuse me. Ken Freinolson, I'm the crop economist, marketing specialist with NDSU Extension. I'll be providing a quick review of the December USDA reports, as well as an update on some of the policy and export pace. So let's dive right in. There's some stuff to go through. First, just kind of the key issues, kind of a really big overview of what I'm going to be talking about. The USDA WASDE and production reports were basically neutral for corn, soybeans, and wheat, and we'll see that in a little bit. There wasn't a lot of adjustment from November into December. We weren't really expecting a lot of adjustment, and therefore there really wasn't a lot of surprise. Over the last couple of weeks, we have gotten some more information and a little bit of a confusion, I think, about the framework agreement that we have between the United States and China. And I'm going to try and go through and help clarify exactly where we are and what the expectations are. And then just as we look forward, especially now as we get into the holiday season, we get a little bit lighter trading volumes. We do have trading over the holidays, but it gets a little slower, a little more sluggish. So sometimes, there just isn't a lot of movement from day to day. But on the flip side, if we do have some kind of a shock or some kind of event that occurs, with the lighter trading, we often get bigger price moves. So I just want to caution everybody, even though typically the holiday season tends to be pretty quiet, just keep your eyes and ears open. So if there is something that happens, we could get a few sparks. Right now, again, the two big things that the market is watching, in particular, U.S. export sales, specifically soybeans to China, but then also the weather down South America. So just a really quick, South America, and especially Brazil, their soybean planting is pretty much finished. Their corn planting is getting close to being finished. In the northern part of Brazil, up closer to the equator, they're in the middle of kind of the growing season right now. So the weather is starting to play a role. So far, it's been relatively benign. There hasn't been any major weather issues. There is some rain expected to come through kind of a northern and central part of Brazil, which will provide some relief. So they need to have regular rains throughout the growing season. Their soils don't have a lot of water holding capacity, so they do need regular rainfall. So far right now, things are looking relatively good for the Brazilian crop. The Argentine, in particular Argentine wheat, looks like it's going to be a fantastic yield this year, basically because they had some really, really good growing conditions earlier on. So let's dive into what the report said. This is the forecast for ending stock. So again, how much grain are we going to have left over in the bin just before harvest of next year? We use this as an indicator of not only our reserves, but then again, how much, how tightly do we need to be monitoring our inventories and make sure that we don't run out at the end of the year. So on the wheat side, there was really, again, back up a little bit. The blue line on top, the highlighted blue line on top, is what the trade was expecting to see. The black line towards the bottom that's been highlighted is last month's numbers, and then the very bottom one in red is the numbers we got this month. So USDA was, I mean, the traders were expecting on average a slight decrease in ending inventories for wheat. That didn't come. We didn't get that. It was basically the same number. There were no adjustments either on the production nor the consumption side. For corn, the corn they were expecting, the trade was kind of expecting a slight tightening of the corn balance sheet, the bottom line number. We did get that a little bit more than what was expected from the average trade estimate, but well within the bounds of what we were expecting to see. Again, when you look at the upper bound and lower bound, we're still kind of in the middle. What USDA did do is they adjusted their forecast for total corn exports for the year. They increased that by about 125 million bushels, and really that all flowed back to the bottom line. So if you look at the November number versus the December number, that difference is completely and totally because of an increase in the expected export pace. And I'll show you some specific numbers in just a moment. On the soybean side, again, very similar. Nobody was really expecting big adjustments. And if you look at the difference between the black line and the red line, we got no changes. I think the trade was expecting that the soybean export number would be cut just a little bit, thus an increase in the ending stocks. We didn't get that in this round. We'll wait to see what happens in the January round. And I will give you an update on kind of what the current pace of exports in soybeans are at and how much China has purchased in just a second. Again, turning to South America, really, again, no major changes between the November and December reports. The trade wasn't expecting a lot of adjustments. I guess one of the things I do want to just point out that's already built into the marketplace, that the expectations are already here, is that Brazil is going to have another increase in their total soybean yield production. And a lot of that is because of they increased the acreage levels. They planted more area of soybean this year. Again, you put a trendline yield on top of that, and you get about 175 million metric ton. On the corn side, pretty similar to what the numbers were last year at about 131. The tricky part about the Brazilian corn is that they have these two corn crops. They got first crop corn, which is being planted right now, and then there's the second crop corn that's planted after they have harvested their soybeans. So the second crop or safrinha crop of corn will not be planted until we get into probably that February-March timeframe. So just keeping an eye on the numbers out of South America. No changes right now, but they are expecting some really, really, really big production out of Brazil again. So let's look at export pace. I showed this kind of graphic before. I do want to explain it very quickly. The four columns on the left-hand side are 12-month total. So that's the full marketing year. The marketing year runs from harvest to harvest. Okay, so the four columns on the left are 12-month totals. The two columns on the right-hand side are year-to-date. So on the far right-hand side, we got an update this morning for our export sales. And USDA, because the government was shut down, USDA has been trying to release more information a little quicker to try and get caught up to the current cycle. And so we're almost there. So USDA is almost fully caught up in the backlog of information. So this is as of, if you've noticed the column on the far right-hand side, this is the amount that we have sold under contract. Some of this has been delivered. Some of it has to be delivered yet. But the amount of new crop corn that we have sold so far this year. And then the column right next to it on the very left of that is the same time period last year. And if you move to the left again, that's the 12-month total. So the moral of the story, if we drop to the bottom line, last year was a record corn export year. Last year, this number of the 69 million metric ton, that is a record number. Okay, and if we look at so far this year versus the same time period last year, we're well ahead of that record pace. And again, it's this really aggressive sales of U.S. corn that caused the USDA to increase the 12-month total a little bit to try and compensate. And this is pretty much across the board. All of our major buyers, when you start at the top with Mexico, Japan, Colombia, Korea, Spain, they are all well ahead of last year's pace. When we look at the ROW, or that rest of world row towards the bottom, again, that's a much larger number than we saw the previous year. The obvious outlier to that, of course, is China. And over the last couple of years, China really hasn't bought a lot of corn from the U.S., and they haven't bought any so far this year either. So the moral is we have very, very aggressive export sales. We're almost 50% above last year's pace, which is really incredible. We do expect later on in the seasons, we start to get some more competition coming out of Brazil, that aggressive sales of U.S. corn, might slow a little bit. But we're still, we're off to a really, really good start. One of the reasons we see some pretty good basis levels locally. Everybody can argue about corn prices, but given the size of this year's production, that's not bad. Shifting to soybeans, it's the same table laid out the same way. The countries have changed. Now we're now looking at soybean and soybean volumes. So let's drop to the bottom line. Last year was not a record production, but it was, and it's not even that great when you look back historically. It's not horrible, but it's not a great number. And then you shift to the column on the far right-hand side. And again, recognize this is through the middle of November. I'll give you an update on what's happened more recently in just a second here. But we are well behind last year's pace. And almost all of that is because China has been very, very slow to come in and start buying U.S. soybeans. Okay, so when we look at the other countries, our other export destinations like Mexico, like Egypt, those are ahead of last year's pace. So we're other than China, this U.S. soybean exports have been reasonably good. But again, China being our largest export customer, the lack of their buying has really made a difference. Okay, so now how are we doing today? As of the most recent information we got, and again, this is as of this morning, we got another announcement of another sale of U.S. soybeans to China. We've sold about 3.2 million metric ton. Okay, now just for comparison, this time last year, China had already bought 17.8. And so again, even though we're starting to sell some U.S. soybeans into that Chinese market, it's well behind last year's pace. And there's a lot of concern about what does this mean now for the rest of our export season. Okay, so that's the most current data we have. Again, this is a graphic I show, and I showed it last month. I just updated some of the graphics so you can see where we're at. This is how much do we sell every week. And this goes back historically. Each of those different colored lines are different marketing years. You can see the red line is where we are so far this year. And we are well behind our traditional or typical pace. The big question that a lot of people are asking is, okay, what will happen now as we move through the rest of this January and February timeframe? Again, recognizing that the information we have is already a little bit delayed because of the government shutdown. Okay, so we're behind the 8 ball in many respects. The question is, are we going to have a flush of sales later on in the season to help pull us back up and get us to the numbers that USDA is forecasting? We don't know. Obviously, nobody knows that for sure. So let's give an update on the trade negotiations from where we are. Remember, last time I talked about this framework agreement between the United States and China, which is basically when President Trump and President Xi got together. They agreed in principle on the things that were going to be in this agreement. They didn't have all of the details, but they did work out some of the major stumbling blocks, some of the major hurdles. Then it's up to their aides and their associates to be able to work out the details and make everything happen. Now, earlier on, we got the announcement that China was going to purchase about 12 million metric ton, and at least 12 million metric ton within this year. Well, okay, so when we heard that in the United States, we assumed that meant till the end of December. Well, what the Chinese said, and this kind of came out later, was the Chinese were using the Chinese year, the Chinese New Year, not the U.S. European New Year. Well, the Chinese New Year starts in the middle of February. And so the Chinese, again, this is a communication, a translation issue, came back and said, well, no, we agreed we'd purchase at least 12 million metric ton through the end of February, not by the end of December. Okay, so again, there seems to be some disagreement or some misinterpretation of what this means based on what the current press releases and what's basically being talked about in the marketplace. It looks like January or February 28th is the kind of the window for China to purchase, not necessarily deliver, but purchase the 12 million metric ton. So for comparison, and I made this adjustment now, last year at this time, from the beginning of the marketing year through the end of February, last year China purchased about 21 million metric ton. So again, even though it looks as though that they are going to purchase, they have agreed that they were going to purchase some more U.S. soybeans, the volumes are going to be very different. And again, the market is watching this closely. The terms that at least that we understand is at least 12 million metric ton. It does give the window, or at least the potential that they might purchase above that. But I know they've also been pretty aggressively buying from Brazil for new crop deliveries. So as soon as we get into the January, well, in particular February time period, that's when the soybeans coming out of Brazil will start hitting the marketplace. And again, that's typically when we see our export sales start to drop fairly quickly. So I am a little bit concerned about the timing of this, and I know it's something that the markets are watching really closely. So with that, I'll stop sharing. I will be hanging on to the end of the program, so if you do have questions, please be sure to write those in or type them into preferably the chat function or into the messaging system, and I'll do my best to answer that. So now I'll hand things over to Tim, and we'll talk about the livestock, something a little more exciting and a little more interesting, I think.
Good afternoon, everybody. Tim Petrie, Extension Livestock Marketing Economist. I don't know if it's going to be a lot more exciting, but I'm just going to cover the market classes of cattle and lambs again, like I usually do, and not add very many other slides. Yeah, you know, there's still a lot of excitement in the cattle business. We are still record high on prices for this time of the year, all-time record highs, and we'll talk about that. And so for those selling cattle, that is exciting. And so we'll start off with fed steers again. Not a lot of cattle feeding up here, but the three biggest things that affect feeder cattle prices are fed cattle prices, particularly those futures prices when the feeder cattle, the feedlots buying feeder cattle, when they can, those feeder cattle will be ready to sell and they can hedge into that. So, we were seasonally higher earlier, up there at 244, whatever, 242, and had some seasonal weakness lately, but a good week last week. And so, we're up a little over $221 for last week. That's compared to last year is $30 a hundredweight higher. And of course, we've been higher higher throughout the year, cyclical higher. Again, the two biggest things that affect the prices are supply and demand, and our supplies have been shorter. We're down 4% on beef production this year, and so it's that's been very, very supportive to prices. So again, the three biggest things that affect feeder cattle or fed cattle prices is futures, then corn prices or feed prices, and then supply. So I'm going to talk about the futures market in a little bit, and I don't want to prolong the agony on that futures market, because I tell producers, let's just watch the cash market and forget all the noise and volatility in the futures market. But, the fed cattle futures the nearby was up $4 because it's got to keep up with cash. But the rest of them were up over $2 today. And when we see the futures market, we've had a nice rebound in the futures market. Go over to the right-hand side there. The February futures today we're 231.30 and we're 221 now. So that means the futures market at least is saying we got another $10 that we can go on fed cattle by the year. And so by the end of the year. And so just see what happens there. And then the gold squares, like I said, are important for feeder cattle prices because that's what the feedlots look at, what they can hedge the feeder cattle that they're buying into when they come out. And they're still at positive levels. I know they've came down and we're higher than that. More on that in a minute, but still relative to history, and the first couple months were above last year, and just a little bit risk off for the rest of the year. So I think that's good news when we're looking ahead to feeder cattle prices, that they'll be supported by fed cattle prices as we go along. But again, when we know we're going to have short supplies next year, demand is a big question, and as of now, demand is holding in very well for beef and all the meat commodities. But that would be one question. If the economy starts struggling and so on, and consumers would back off, that would affect us. But no indication of that as now. And the export market too. I didn't bring the slides on that. The export market for beef, our biggest customers again are Japan, Korea. Then it was China, and then Mexico and Canada, but now we're not shipping any to China and probably may not in the next, at least immediate future, but the other ones are all hanging in there very strong. And so, that's helping prices as well. So, here's the futures market. I debated whether to even show you this because of all the noise and so on, but just kind of give you an update. Last time I explained, what happened is on October 16th, for over a year, both the fed cattle, live cattle futures on top and the feeder cattle futures on the bottom had been up, and the funds jumped in and doubled open interest and so on. And then the October 16th announcement you see there in the square is when Trump said he wanted to bring beef prices down, and he was going to, open up more for Argentina and all those other issues. And so the funds bailed, a bunch of them. Open interest went down, and then we had all this volatility. See all those long lines there, and limit moves down, but once in a while up and so on. So, let's just go to recently there. We have came up quite nicely, $25 or more back up from those lows. And speculative activity always causes the market to go up a little too high when it's going up, particularly when it's been going up for a long time. And then when it goes down, it goes down a little bit more than it should fundamentally. And that's kind of what has happened here lately. And, you can argue whether that's good or bad, like I said before. Running it up higher for something you have to sell offers opportunities. And on the other hand, running it down more than it might fundamentally offers opportunities for those that want to buy futures to lock in a price for the future. But anyway, we've came back up quite nicely, $25 or so on the futures market. But one thing I just wanted to mention is, at least the last week we've had, not as much, and this doesn't include today. And the other charts I had today's futures, but just didn't update. We've had less movement within the day compared to a month ago when we were doing $5-6 on fed cattle almost every day, and down on feeder cattle even more than that. Sometimes $9 or $6 were common movements. We've kind of lowered that volatility a little bit, although feeder cattle futures, we'll look at it, the cash market in a minute. The feeder cattle futures were strong again today, up about $5, but actually they're just recovering from being oversold there. And so if there are more questions on that, but I'll try to answer them. But I'm just going to go along and concentrate on the cash market. So start off with our steer calf prices now that again, we're at all-time record high levels. I know 2 months ago we were a little bit higher, but we just had a kind of really a blow off top there when everything was just absolutely going our way, and they backed off a little bit. But calf prices compared to this is last week, compared to a year ago, are $106 a hundredweight, all-time record high for this time of the year. Although again, I realize a couple months ago, seasonally, they were a little bit higher. So, calf prices are bringing very good prices there. A 570 weight calf bringing 431, or the market, is bringing it right at $2,500 a calf. So, I think for the most part, producers are happy with that. And again, I had covered this last time, but everything, particularly when we ran them up to just for a couple weeks there to 480 before the futures market kind of went down, everything that could be positive was positive. Again, we had strong fed cattle prices in the futures, short supply. The Mexican border is closed. Is closed. We'd be getting 25 to 30,000 Mexican calves a week, and that border is closed. We're retaining more heifers. There were good winter wheat conditions. I just talked to my counterpart down in Texas this morning. So they're scrambling to get cattle to put on there. They're even trying to keep their cow herd, as much as they can and cows, because they're not getting the Mexican calves to come in, but they've got, really good winter wheat conditions. We added new feedlot capacity, again, 150,000 head feedlot just finished up being built in Nebraska, and they're even going to add on to that, and low corn prices that Frayne has explained. And then, the other thing, when we have a record crop like we do of corn crop, that brings in more of the smaller corn belt feeders, the southern South Dakota, Minnesota into Iowa feeders, that if corn is $7, they just sell it. But if corn is 4 or whatever, then they tend to want to, and with increasing prices for cattle. So we just had, for that big spike in prices, that up in the upper left hand there, I just pulled some stuff from 2 market reports, and that the USDA market reporter said what was really causing the spike in prices. And again, they mentioned southern wheat buyers. These are North Dakota, Montana markets, but they're buying calves from up here for that southern winter wheat. And then, interestingly enough, even though our prices are high, the Canadian buyers have been aggressive for our calves too. 30,000 a month or so going up there, because they had a really good barley crop up by Calgary and in the cattle feeding country up there. And so and their cow herd has been going down percentage wise more than ours. And so they've been buying too. And then, so, we had the southern wheat buyers and those small corn belt cattle feeder buyers and the Canadian buyers all aggressively getting after calves. There is what really caused that spike, and is still continuing to help the market there. The other thing I just wanted to mention, when we talk about, the futures, there's whenever there's a rumor, the Mexican border is going to open up, the futures market crashes the limit and so on, like it's going to be some event that's going to really cause cattle prices to go down. So if you go to the left hand side, the Mexican border was open there from the 1st of February until May 9th or 11th, whatever it was. And you see our calf prices even continued up with that Mexican border open. But I realize in the fall of the year here, some more do come in, but it wouldn't have to have a huge negative effect. Looking ahead now to next year, you see, and the border is likely to open up sometime next year. And we usually are short of cattle, are getting heavier and heavier. So we get fewer and fewer 550 to 6 weight calves in the spring there. So even if the border opens up, it wouldn't have to have a catastrophic negative event on the cash market, because actually it didn't last year, and it would be a normal occurrence. So anyway, calf prices are doing very well. Go to the yearling prices, and the same fundamental factors are affecting heavyweight feeder cattle that I just got through talking about. We've got a short supply, and corn prices the same as last year, and so on and so forth. And, there's the futures market today was up about $4. So at least the first half of the year, the futures are saying higher than last year. Kind of risk off at the end of the year. If there is a chance that fed cattle futures could do better than they are, all depends on a lot of factors. And again, back to those supply and demand factors I issued. But still, those futures are, from a historic standpoint, up there at relatively good prices. We could have both for all the feeder cattle, we could have cyclically higher prices next year, but seasonally lower in the fall than they are now because of all those factors that I talk about. What if corn prices are higher? Or what if we don't have winter wheat, and so on, all those things that were so good, that we don't get. We know we're going to have a short supply, so that's supportive to prices. But some of those other factors that are so positive this fall, if they weren't as good next fall, that could cause price to go a little bit down, and that's what the futures traders are risk off and looking at those. But still, these 750 to 8 weights are $84 higher than they were last year at this time. So, generating good money for those selling calves. Then, the other part of our profit picture is cull cows, and the same story there. They're at record high levels, and they have not, usually in the fall when we PG check and all the open cows come to market, or the cull cows, that certainly causes the market to go down some, but they haven't backed off hardly at all like they do sometimes seasonally, because there's a really, really good demand for cows. We're selling a few of them, to retain them for rebuilding the herd, and because we've got forage available and so on, and there's a really, really good demand for hamburger as well, because that competes with the other markets. So cow prices are staying in there. One other thing I always mention, we're there at about $150 for these very lean, 85-90% lean cows, which basically would be a broken mouth cow that had a calf on her all year. But, there's a wide range, just like there's a wide range in calf prices that, I didn't mention a lot there. But, last week, $431 was the average on 556 weight calf prices, but the range was huge there, about $60, all the way from $390 to $450. And so it's the same thing on cows. There's a wide range in cow prices. I just pulled a market report here from last week at that market, and you see they sold cows up over 200, but they also sold them down at 130, the low yielding cows versus the very high yielding cows. So I have a kind of a middle of road price here. The trend is the same whether they're high or low, but again, cows are good value as well. So just finish up with lambs that like I usually do, and like cattle prices, the same thing is happening for lamb. Prices are very strong this year, historically high, and usually they go down seasonally in the fall and have not went, and have really sparked the last couple of weeks as well. And so again, it's supply and demand. Our supplies of domestic lambs are a little bit lower. Our lamb production is only down now about 1% or a little more, but the weights of lambs are off quite a bit. And so, that's down about 8% over last year on lamb weights. And that's positive, because sometimes lambs when they're held, they get too heavy, and then you really see a price discount for those heavy lambs. But there's such a really good demand for lambs that, they're being sold, and the market is very current, and the slaughter weights are down. And, supply isn't the problem there. And then, we've got strong domestic demand, but we've seen an increasing in this year, a really spark in export demand for lamb. We don't export a lot of lambs. We do import a lot of lamb, more than we produce for the box stores and so on. But there's really good demand for our lamb, and our exports are up 50% this year, and a lot of that is going to, just like beef does the same thing, but it's going to the resorts in Mexico and the Bahamas and the Caribbean. Those resorts, motels and stuff down there. People are developing a little bit more taste for lamb, and a lot of our high quality beef goes down there. And now there's a big demand from those resorts for our high quality U.S. lamb too, up 50% for the year, which is a nice boost to our prices here and why they're at those levels. So with that, Hope you all have a great holiday season and you don't have to do too much shoveling, like Brian said. And I'll stop sharing and move to Dave.
All right. So just briefly, so we can get to questions and get a little bit closer to Christmas here. I have some comments to make just about the new Trailblazer carbon pipeline in Nebraska. Really to make sure that everybody kind of has this on their radar in terms of carbon capture and storage and the economics of it. And of course, we have exposure to this in North Dakota as well. First thing, just to talk about the project itself. So Trailblazer Pipeline, owned and operated by a pipeline company that has a number of assets in the central part of the country. They converted a natural gas pipeline to CO2, and it was put online in October. The idea, similar to what it is for Summit, in this case, they're planning to take CO2 from corn ethanol refineries in Nebraska and Iowa to geology in Wyoming, inject it and store it. They're doing it, in real time, and so the pipeline is operational, but they're continuing to add refineries as they have the legs to get the CO2 from those locations to the pipeline itself. Eventually, there'll be 11, be relatively sizable, and again, is operating now, build out to 11, one of those in Iowa. So thinking about the economics, and I think it's really important and interesting, especially the magnitude of the incentives. And so there's a few different ways that a project like this can capture value. So with the idea that they have taken atmospheric carbon that moved through the corn plant to the kernel, into the refinery, was fermented. Fermentation would result in CO2, and they're going to inject that in the ground. It generates a 45Z tax credit, which is the new tax credit for clean fuel production. Again, came online this year, updated, extended additional funding with the One Big Beautiful Bill. The amount of that tax credit alone is quite substantial, 65 cents per gallon of ethanol. And just think, we'll kind of compare this to the price of gas, right? So the price of gas, somewhere around $3. The price of ethanol, about half that, just a significant amount of additional revenue. And it's important to note that's just from 45Z. The actual amount of the tax credit would depend on the specific carbon intensity for the project, which we don't know. In this case, they have to use the GREET model that was developed specifically or modified for 45Z. But we don't know exactly where it's at, but we know it's somewhere in this 60-cent range. Also important, again, that's paid to the corn ethanol refinery. They're the producer of the fuel. At the same time, if you look at the structure of this market, you might have multiple corn ethanol refineries, but you have a single pipeline which has monopoly power or monopsony power. So they definitely get their share. The pipeline company definitely gets their share of this payment. It's also really important to note that 45Z can typically be stacked. And so you might be able to capture other sources of revenue, selling carbon offset credits, selling the fuel into low carbon fuel market states or provinces or countries, e.g. California, the West Coast, Canada. And again, going from, your baseline profitability plus 65 cents for 45Z, plus the carbon offset credit, plus the LCFS credit. I mean, it's really substantial when considered in total. And again, just to bring that back to North Dakota, so there's a few ways in which North Dakota is engaged with this carbon activity. Some on the fossil fuel side, some on the bioenergy side, on the ag side. Again, mentioned a variety of times before, we do have a long-standing carbon capture use and storage project in the state with Dakota Gas and Beulah. Again, they've been around for decades. They've actually been capturing CO2 for 25 years, almost 25 years. They have used it to produce nitrogen fertilizer, and they've also exported it, used it for enhanced oil recovery in Canada. And of course, more recently now with bioenergy and carbon capture, which is that BECCS acronym, we have 2 operating facilities in Red Trail and Blue Flint, and actually not Red Trail anymore, Gevo, Richardton, and Blue Flint. And so you can see from that map where those are located. The red dots are operational facilities. The red dot right across the border is facility in Estevan, Saskatchewan, and it has carbon capture as well. And of course, all of the ethanol refineries in the state, those in the region were, partnered with Summit. Summit is still working to get a project developed. And that's one reason why I want to just help educate on what the economics are for the refinery and others, because it is really important. It's extremely impactful. It's a tremendous amount of revenue. It absolutely stabilizes ethanol corn markets for a region. And in fact, there was a statement made by Monty Shaw, who's the head of the Iowa Renewable Fuels Association, that and his statement was that Iowa was no longer the low cost producer of ethanol, the most profitable place to produce ethanol. And again, if you're talking about someone else having a 65 cent per gallon advantage over you, or some portion of that, that's a tremendous amount of money. Again, since ethanol is competitive business, and you're very much in the pennies of profitability business. This is just a giant swing in the economics of corn ethanol. So that's what I officially had. I'm going to bring everybody back online. We'll address some questions. Again, use the Q&A tool or the chat. As I mentioned at the beginning, we're going to continue the webinar in 2026. You'll be getting an email or series of emails to register, and keeping our current schedule, the Thursday after the next WASD would be on the 15th. And so that's the tentative date for our next webinar.
Nope, just that I hope everybody has a great holiday season and stay warm and please stay safe.
Yeah, absolutely. Well, we'll end with that. So thank the presenters. Thanks everybody for attending today. We'll be back next year. And please look for those emails regarding registration and the continuation of the series. Thanks.